So today is inflation day. We got the CPI headline and CPI core. And let me just first acknowledge with something by standing up. I was wrong. And I expected CPI headline to come in at 5.2 or quite possibly even 5.3. It actually came in at 4.9. So that is the 10th month of declining inflation in the CPI reading. So I thought I wanted to talk to Anna Kelly about what she sees in inflation, what she sees going forward. So Anna, I don't know if this surprised you. It clearly surprised me, hence wearing this shirt. What'd you think of that number this morning?
It didn't shock me only because, obviously we have credit markets tightening. We have a lot of fear with the banking sector. What's happened with, three of the top four banking failures have happened in the last couple of months. And so consumers are starting to pull back. So that doesn't shock me. I think there's a little bit more fear than there was, and that's doing some of the work for the Fed to bring inflation down. What I did expect was that we might see an increase in certain numbers, and we did. So although inflation went down to 4.9%, it's under that 5 number. It's actually up 0.3% compared to the last month's inflation report. So gas has gone up 3%. Rent has continued to climb.
Yeah.
And I've read mixed messages depending on the reporting on whether food has actually gone up or down. I think certain segments of food have continued to rise, which doesn't surprise you when you look at the fact that energy costs have gone up, which trickle through the economy. So I'm not surprised that those areas, which are excluded from core, but they're part of the key parts of inflation and CPI, are continuing to go up. And it wouldn't shock me if those numbers still come up while overall CPI continues to come down.
Yeah, for me, this was the one number, the 1 month that Jerome Powell was frankly probably freaking out about. Because I actually think on to the next 4 months all go in his favor. For the next 2 months, we have the largest roll off in what is called the base effect. Last June, it was up 1.2%. It won't be up 1.2%. Even if it's flat, it'll be up 0.4. That will be a 0.8% fall. So
Right.
I think the next 2 months, we could see the low fours, maybe the high threes. And then the next 2 months is what I've been telling my audience about all year. We finally will see the housing roll over, right? Housing was still 60 or 62% of the inflation reading this morning. It won't be come July or August. So I think the next 2 months, base effect monster 1.1, 1.2. The 2 months after that, we see housing material finally roll over. I think Jerome Powell's mid threes in 4 months. And I think he's like, we get low threes. We have a 2% real interest rate. He's going to be like, I'm winning. We're getting there. So I think the next 4 months are probably the winds at Powell's back. What do you think?
Yeah, it's really tough to say, but I think to your point, the housing equivalent number in the inflation numbers, there's a significant lag there. And so, that's part of the problem with looking at data and responding to it and trying to be always like responding to the data instead of looking at, kind of leading indicators and how these lags actually work. You can make the argument that the Fed has made a policy error in raising rates too high, too
Sure.
fast,
Sure.
not understanding that some of these numbers that are higher are actually probably lower in real time than what the lag of reporting allows us to see. So I do think that inflation generally, if we continue to have credit tightening and if we hit a recession officially and it gets bad pretty quickly, I think that will freak out the consumer enough to pull back in spending and really see a rapid decline in at least current inflation. So that's very possible. I don't know that I see us getting to the threes. I don't know that just because of the fact that when you break down each of the components, energy is still up. Housing to your point could come down, but as someone who provides a lot of housing in different states, it's very regional, as we always talk about. So in some areas, our rents are actually still rising. It's all about supply and demand in that particular market. So tough to say. I think we continue to see inflation fall. I think it's going to be a little stickier higher than maybe what you do. I don't see us getting into the threes in the next few months, but I could be pleasantly surprised and be wrong.
Yeah, no, I again, I don't know if you read this report. It came out yesterday and it was pretty meaty from Pantheon Macroeconomics. So I read this report before the CPI reading this morning. And Ian, I don't have his name in front of me, but the chief economist, Ian something, was saying that that inflation, so CPI headline, I'm guessing, it never said, it just said inflation, could be sub 2% by mid 2024. And when I read that
I did see
yesterday,
that.
I'm like, this guy's crazy, right? By mid 20, that's like a year from now. But after this
Yes.
morning's reading and then kind of looking behind the scenes, I'm like, well, it's not probable. It's certainly not my base case, but as of this morning, I'm like, well, that's a bold call. I can appreciate that. So what do you think when you
Yeah.
read it?
When I first saw it, I thought it's not going to be that way unless we hit a very hard landing in a deep recession. I mean, so here's, we get excited to think, okay, inflation's back down. But for it to go from like
Yeah.
booming economy, high inflation to that low that quickly, that means that something big happens between now and then. That's
Yeah.
very deflationary, i.e., a recession, slowing growth and slowing, all components of CPI. And so, if you say, what's the chance of that happening? I mean, I think you and I have both, been on record multiple times saying this is going to end in a recession. The
Yep.
question is how deep and how long. I tend to think that it's going to be deeper and longer than what you do, I think.
True. Yep.
But if that recession is a harder landing and lasts longer, then you're going to see inflation come down, much more quickly than if we hit a soft landing and we kind of have to play this game for a longer period of time between, slow growth and inflation, i.e. this stagflation that we've talked about. So the question is, do we have a hard landing that, brings inflation down fast, or do we have this soft landing and we're going to be in this dance for a couple of years before we really
Yeah.
get inflation under control? I really don't know, but I think it's kind of 50-50. It could go either way.
Yeah, Stanley Druckenmiller is certainly in your camp. I don't know if you saw he's out talking again. Great macroeconomist and macro investor, right? Only manages his money now.
Yeah.
But he's basically saying we're in for a hard landing. He actually said unemployment rate, which currently last reading was 3.4, will be over 5% a year. Hard landing, meaningful, nasty recession,
Yeah.
and that's kind of where he's at.
Yeah, I haven't read that, but I tell you, there's some data that I've been tracking, and I pull from a lot of different economists. So I'm sorry to not give credit where it's due, but I can't remember who put out the report. But I was just listening to an interview with Stephanie Pomboy, and she's a macroeconomist, and she really thinks we're heading toward a hard landing as well. And she was showing some data just in the last couple of days, where if you go back and you look at the history of hard landings or soft landings, every time that it's been a soft landing, it's been preceded by a period of economic easing in order to accomplish that soft landing. Every time that you've had economic tightening at the point that you hit a recession, it's been a hard landing, like every
Yeah.
single time in history. So we're tightening into otherwise recessionary conditions, as we talked about last week. Yes, you've got wages still high and you've got employment still high, but every other key indicator, 8 of the 10 that the National Bureau of Economic Research uses to date recessions, they're already in
Yeah.
recessionary territory. So, tightening going into a recession, it always leads to a hard landing. So
Yeah.
I think when you combine that with the fact that we're just at the beginning of credit tightening, and so one of the things that happens to allow for a soft landing is that credit is usually easing. And so because it's easier to go borrow money when you're heading into some difficult times, before you hit a hard recession, that kind of sometimes allows you to have this soft landing. We've seen banks start to tighten over the last year, and really the secondary markets for financing, the insurance companies, the big hedge funds that provide liquidity, they've already been tightening for quite a while. It's just starting in the banking sector. So I think what's going on with the banking crisis, increased reserves, deposits leaving, banks starting to tighten at the same time that you've got all this, these high rates heading into recessionary territory. I just don't see any way out of a hard landing. I hope that I'm wrong, Michael. I really
I
do.
know.
But
Yeah.
the
Yeah.
data that I'm looking at, doesn't bode well if you look at history for, the kind of the headwinds against allowing for that really soft landing. So I think it's going to be harder. And if it's
Mhm.
a harder landing, if it's a harder recession and it's deeper and longer, if it affects the banking system and credit remains tight for a long time, then yes, I think that inflation starts to come down and we switch gears to fighting the
Yeah.
monster of a deep recession and make inflation fighting, maybe long-term inflation fighting take a back seat to trying to get us out of a deeper recession.
Yeah, and kind of on that end, there was it's actually a survey once a quarter. It's called the SLUICE survey. It's not something I look at regularly, but I did look at this month Senior Loan Officer Opinion Survey, uh, talking about basically credit getting tighter, which is
Yes,
it's a continuation of the trend, and more importantly, all surveyed thought it would be tighter for the rest of the year, so not getting better. And then more importantly, what did surprise me is demand for credit was down across all categories: autos, credit cards, personal loans. I think this is really a sign that the consumer got scared in March because it is a Q1 survey.
right,
So I expect the Q2 survey to be meaningfully down from there. So, kind of your end that we are an economy that's based on credit, and we
right.
are seeing credit contract and demand and ability to get a yes answer contract. It's kind of pointing that way, I think.
Absolutely. And I don't think the markets are really, pricing this in. We're beating these expectations of earnings, but the earnings expectations continue to be dropped lower and lower. But if you look at like corporate bankruptcies that are starting, they're about at the level that they were in 2008. And so we're starting to see
And going
tighter
higher. Yeah.
credit and bankruptcies increasing, corporate credit defaults, auto loan defaults. We haven't seen as much in the consumer loan defaults, but we're starting to see it in corporations and commercial real estate, et cetera. And so I just think that there's a lot of negatives going on in the economy, with this rapid increase in interest rates. I think it's the speed at which they
Yeah.
got so high, given an economy that really depends on this really low rate debt. And the fact is, even though the consumer's pulling back a little bit, so earnings are starting to fall. If you look at the producer price index, costs are still going up, and these companies are not able to kind of pass it through to consumers. So I still think you have, real recessionary conditions happening that are going to make for a hard landing and start to bring, at least in the short term, inflation down potentially substantially. And I guess in that regard, I would say, could we be at 3% end of year? If it's a hard landing, yes.
It's possible.
Otherwise,
Yeah.
I don't think so.
Yeah.
But we'll
And let's be
see.
clear, in
It's
the threes,
interesting.
in the threes, not
In the
three.
threes.
In the
Yeah.
threes. It could be 3.9 and still be there. So yeah.
Right. It's
It's
like pick
it's
your poison,
yeah,
more
exactly.
inflation or a hard landing. Hopefully we get one extreme or the other. The Fed has tools that they know exactly how to
Yeah.
counter it. And we're not just kind of in this bumpy year, couple years of slow growth and rising inflation and stagflation, which has really been the thing I've been most afraid of,
Yeah.
going into this environment that we're in.
Yep. Well, I was thankfully wrong on CPI or inflation. We have now 10 months in a row down from 9.1 all the way to 4.9.
Yes.
I think the next 4 months are negative, are down. I do think we get to the low or high threes, but we'll see. Anna, where can people follow you? Because you put out amazing stuff almost every day.
Thank you so much. You can follow me on your show and on my playlist on your channel. You can follow me on social media, Anna Kelly, REI Mom, and my website, reimom.com.
So much.